On behalf of the CFA Society Pakistan, we are bringing to you another webinar today, and we have the pleasure and the honor to have Mary Leung, who is the head of the Advocacy Asia Pacific CF Institute, to lead today's event. As you know, ESG standards is a very recent initiative of CF Institute, and it is in the draft form at the moment. Globally, there's a lot of interest in the ESG, and as a thought leader, CF Institute decided to come up with a standard because it has, as you already know, they have world-renowned standards in the area of code of ethics and standards of professional conduct, asset manager code, GIFT standards. So this is a new initiative, and deadline for submission of comments is getting very close now. So we thought it would be appropriate to request Mary Leung to introduce the subject to you and to share a very high-level view of the ESG standard, so that the members can have the understanding and the opportunity to submit their comments before the standards are finalized. As you all know, most of you know Mary Leung because she has been to some of our events before as well. She is the head of Advocacy Asia Pacific region at CF Institute, and she leads a team that is responsible for building market integrity in APAC by developing and advocating capital market policy positions that raise investor protection and foster sustainable industry growth. She also oversees the promotion and development of ERX. And if you are not familiar with the ERX, I would suggest you to just Google it and go through the CF Institute website, which is a very rich hub for research, which is not only done by CF Institute, but also done by several societies. So there's a lot of information available there, which is very useful. Mary has been on the business side before. She has 20 years of experience in the global financial industry. Since most of you know, I will not go into further details about her. And I will now quickly jump to the housekeeping rules. I think the housekeeping rules are being displayed right now. So we will try to keep this session short. It's a 1-hour session, including Q&A. And we would, because to ensure maximum bandwidth, we would request all of you to keep your videos turned off during the session and to stay muted. Once Mary has completed the presentation, there will be a Q&A session, and you can submit your question through the chat box. And for the benefit of the members who are not here today, or those who are here today but would like to listen to the recording again, this session is being recorded. It will be posted on the CFA Society Pakistan website. And towards the end of the event, there will be a feedback form that will be shared with you. And we would appreciate that you give us your valuable feedback so that we can improve further. So without further ado, let me invite Mary to start the session. Thank you, Mary.
Thank you, Mohammed. Good evening or good afternoon to everyone. I'm here, and thank you, Mohammed, for the very generous introduction. I'm going to talk to you about ESG, the ESG disclosure standard that the Institute has been working on. But before I do that, I wanted to spend maybe 5 to 10 minutes talking about ESG in general so that we're all on the same page. So before I start, let me do a polling question. Okay, and hopefully, then I can gauge where we are in terms of knowledge about ESG. So, how familiar are you with ESG integration? Are you a newbie, or do you know enough to bluff your way through a meeting? Do you think yourself as a pro? Think of yourself as a pro, or are you, struggling with what ESG actually means? So the polling is anonymous. You do not have to be embarrassed. And but if you think you should be the next speaker, please let us know. So next time we can invite you to come and present the session with us. So I'm seeing a few results coming in. About half of you have voted. So please keep your votes coming so that I know where things are. Excellent. Okay, maybe a few more seconds. Okay, let's maybe show the results. Right, I think over half of the people who have selected, who are in the room have selected the newbie option. So great, we will hopefully after this session you will know a little bit more about ESG integration. Quite a few of you think you know enough to bluff my way to a meeting. Look, I get it, I find myself bluffing my way to a meeting as well. And to the one pro in the audience, please give me your feedback. And next time, please come and share the stage with me, okay? So let me start by, Let me start by showing you this graphic. I think a lot of people have been interested in talking about ESG. Especially in the investment management profession. But there's actually a lot of confusion as to what ESG means. The three letters stand for environmental, social, and governance factors, but there's a lack of agreed definitions in terms of exactly what one means if they say they're doing ESG investing. And it's like the proverbial elephant, you know, if you're blindfolded and you touch different parts of the elephant, you will come up with a completely different description as to what the elephant looks like. So, but it doesn't actually detract from the fact that ESG is the importance of ESG. So when we look at ESG issues, as I said, they're environmental, social, and governance issues. On the environmental issues, some of the more high-profile issues include climate change, energy efficiency, waste and pollution, and water and resource scarcity. In terms of social, we're looking at health and safety of employees, other stakeholder concerns like, for example, customers or suppliers, demographics, labor and supply. So these are social concerns. Corporate governance probably have a much longer history in terms of being featured on investors' list. And there are things like audit quality, risk management, board structure, remuneration, and shareholder rights. And the reason why people are increasingly focused on ESG issues is because a significant amount of a company's value comes from intangible drivers, such as corporate culture and approach to sustainability issues. And looking at ESG issues allow the analyst or the investment manager to have a more complete picture when they're evaluating a investment opportunity. So, and that's increasingly important because in this day and age, returns and risks are increasingly interlinked, okay? In the work that we do, in talking to our global membership, we have been told time and time again that sustainability is the theme of our time. And the financial industry has a key role to play. And there's a growing consensus that in an increasingly complex world, risks, returns, and reputations are all interconnected. And investors need to take a broader perspective to ensure that the business that they are integrating in, that they're investing in, are going to be here tomorrow, that they're not going to be washed away because of reputational issues or fell foul of regulation. And I suppose the imperative is not new. What is new is the momentum behind its implementation. And what we're saying is that by incorporating material ESG factors into the investment analysis, we're empowering investors to make more informed decisions. Okay. I really like this chart. It's taken from the global risk reports that the World Economic Forum puts out every year. And on this chart, it shows the top 5 risks in terms of potential impact that people surveyed by the World Economic Forum sees. If you look at all the different colors, basically the blue boxes are the economic risks, the green boxes are environmental risks, red social, and yellow geopolitical. And basically, if you look at the risks 10 years ago, most people were worried about asset price collapses. There were economic risks that they were worried about because we were coming out of a global financial crisis, and people were concerned about asset price collapses, financial system failures or fiscal crises. Now, notice how the colors have changed in the last 5 years. We were a sea of blue 10 years ago, but now we are in a sea of green, okay? People are increasingly worried about environmental and social risks. They're worried about extreme weather events, climate, natural disasters, and water shortages. And over the last few years, we have been doing a lot of work with other partners such as PRI. And when we surveyed, over 1,000 practitioners around the world, and what they told us globally is that the single most important driver for doing ESG is risk management. Many investors believe that the impact that these factors on equity and bond prices will only increase. And so if they ignore these factors, they're doing themselves a disservice. But for many asset owners and also asset managers, they're also trying to put their front foot forward, and they're treating the problems as opportunities. And they're thinking that if they can identify the companies that are best placed to provide solutions, they're onto a winner. So there's a risk perspective, the very strong risk management perspective, but there's also an opportunity perspective. Now, I had this elephant at the beginning of my slides because different people have a different interpretation of ESG. For us at the CFA Institute, we look at is ESG integration. And I just want to put it out there as to what we mean by ESG integration. And it is the systematic and explicit inclusion of ESG factors into investment analysis and investment decisions. What does that mean? It means that we're analyzing both financial and ESG information. It means that we're identifying and assessing the impact of material, financial, and ESG factors. And we're making an investment decision based on all material factors, including ESG factors. Okay? What it doesn't mean is that we're going to exclude certain sectors, countries, or companies from our investment universe. It also doesn't mean that we ignore traditional financial factors, or that portfolio returns are sacrificed for the sake of performing ESG integration techniques. So this is very, very important slide. It's very important to us that we are all on the same page as to what we mean by ESG integration. So quickly, I want to show you this slide because 2020 is anything but a normal year, okay? And for many people, it's kind of the first time that ESG was tested, since people start talking about it 5-10 years ago. So, and the consensus is that ESG has had a pretty good crisis. It has done really well in the time of COVID-19. And what we've seen is that companies that have managed well, that are paying attention to the stakeholders and paying attention to different to managing the business in a sustainable way, tend to outperform those that haven't. So we have seen massive influx of fund flows into ESG funds. We have seen ESG indices outperforming traditional indices. And in a number of roundtables that we've done with practitioners in the region and around the world, they have very clearly told us that they think this trend will continue. So are you ready? So I think there are a few things that we can all do to get ready. Training and upskilling is one of them. I think it doesn't stop at as investment professionals. We need to also train our clients and start talking to them about the potential of deploying the funds in a way that's sustainable. Issuers need to train up their board and management to think in a way that's sustainable. For the industry, I think it's about innovation and coming up with product design and disclosures that will put them to position them for the next wave of interest. And if you are doing ESG, that means you have to engage with the companies that you invest in and motivate them to do better in terms of sustainability. And really the bigger, I think the bigger message is to focus on purposeful capitalism. So shareholders are obviously very important. Us as shareholders are very important, and we need to move the, try and move the needle and make sure that the economy, the companies that we invest in are resilient. So with that, I will end this little session with a second polling question. In your view, which ESG factor is most important when it comes to investment analysis? Is it A, environmental, B, social, C, governance, or D, all of the above? Wow. Interesting. So I've got about half of the answers. Half of you have voted. Let's keep the poll open for another 10 seconds so that we can get more answers. Okay, maybe we can show the results now. So 61% say all of the above, followed by governance, which had 32%, and 11% said environmental. So there's no right or wrong answer. I find that each market is different. I think in the past, a lot of fund managers have told us that they had concentrated or focused on governance because they found that it had the most alpha potential. And indeed, there's a much longer track record in companies disclosing their governance, their information about governance. Environmental is catching up, and I think after, as a result of COVID-19, we're also seeing quite a bit of attention being placed on social issues. So I think it's all evolving, and it varies from market to market. Sorry, have the results been shared? Sorry. Yeah. Okay, so as I said, 61% selected all of the above, followed by 32% governance and 11% environmental. So thank you for participating in our poll. So with that, I'm going to switch over to talk about the ESG disclosure standard that the CFA Institute is working on. So bear with me. All right, so here's the meat of today's presentation, and again, thank you very much for your interest in our latest product, which is the ESG disclosure standards for investment products. I'm very excited about this. It's one of our key pillars in driving professional excellence. And we've reached a very important milestone in August when we launched the consultation paper. So I would like to start by talking about the market need for this standard, which is driven by two factors. As we've seen, there's been an increase in awareness of ESG matters among investors. And there's basically been a huge explosion of interest in ESG investing in the past few years, both at the fund manager level as well as the asset owner and the retail investor level. And as I said, so ESG had a good crisis. We've seen strong inflows into funds during the first half of the year. And when we launched our trust study early in the year, 70 to 75% of our respondents in the trust study said they have an interest in ESG. So this interest has been basically kept at a very high level. And so that's the first reason why we were interested in developing the standard. The second reason is basically what we alluded to earlier, is that there's huge concern about claims of, by different products of what they can do, okay? There's lots of confusion about ESG. It's difficult to really understand what people mean, and it's very difficult to evaluate a product's claims and determine if a product is suitable. So in the same trust study that I was referring to, even though 70 to 75% of investors were interested, only 10 to 20% actually have any money in ESG-related investments. And that survey was actually done before COVID-19, so things may have changed. But you can see that there's a big gap between those who are interested to those who actually put money where the mouth is. And we believe that the confusion or the lack of understanding may be the reason why we see such a big difference. So then we think that maybe if we come up with an industry standard, we can address confusion. But the million-dollar question is, what sort of standard are we trying to do? And this is the question that the consultation paper seeks to answer. So here's the landscape of all the ESG-related standards and regulations. And before we started this project, basically we looked at what's already out there. And it's a long list, okay? So the very first thing that we did was to research the standards and regulations that were already out there and in the pipeline, so that we are not creating something that's already been done. But look at this list, right? It's a long list, okay? And it's by no means exhaustive. It is a very crowded space. But each standard probably has a slightly different purpose. So after analyzing all the efforts on, all these standards on this page, and speaking to some of the organizations and regulators that help establish some of these standards, we have decided that there is a space that we can contribute, and that is in the specification for investment product disclosures. And that's the first row on the top. Okay. You notice that there are two other efforts in this category. One's called the SFDR, one's the EuroSIF SRI Transparency Code. They are both from the EU, and the SFDR is a piece of legislation and basically statutory requirement that are placed on asset managers at the entity level and at the product level. The SRI Transparency Code is focused on products that are green, social, and ethical funds, and it's geared towards primarily a retail audience, and it's a voluntary code. So how is the CFA Institute ESG disclosure standards for investment products going to be different? In a nutshell, what we're trying to propose, or what we're proposing, is a standard that's global, and that's voluntary, and that applies to investment products. It will be a descriptive standard. It's not prescriptive. And the purpose is to help provide greater transparency and comparability for investors when it comes to ESG products. And it will help investors identify and select products that most suit their needs. Okay, so I think a lot of you may be familiar with GIPS, so there's some parallel with GIPS that I can go into later. But this is what we are trying to do. We're trying to come up with a standard that will help asset managers better disclose the ESG features of their investment products to enable investors to better select and identify and select the ones that are most suitable for them. So just so we're absolutely clear, our purpose is to provide greater transparency and comparability so that investors can help can better identify and select products that most suit the needs. And to achieve this objective, we need to define and classify ESG-related features and establish disclosure requirements and procedures for independent examination. Okay, it is not our intention to establish disclosure requirements for corporate issuers. So let's say if we have a big company like, I don't know, BP, for example, we're not asking them to disclose, our standard has nothing to do with the issuer. So it's not about them. It's also not our intention to prescribe requirements for the labeling or rating of securities or investment products. We are also not trying to define best practice for a particular strategy or approach, or develop criteria to assess or measure the sustainability of economic activities or investment products. We are also not trying to advance principles to be used in investment decisions. So this is how our standard will be different from what's out there. Now, next, I would like to share a little bit about the process in the development of the consultation paper that's out there. In January, we selected 15 volunteers from over 200 applications to serve on our ESG working group. And they were selected for their ESG expertise, the regional perspective, and the experience either as asset owners, asset managers, consultants, or service providers. The group met once every 2 weeks, and they've committed hundreds of hours to providing the to discussions and debates about what should be done. And if you look at the consultation paper, you can actually see the names in the appendix. And for us, the importance of involving volunteers cannot be, it's very important for us to include volunteers in a process like this. By bringing together multiple perspectives, by bringing together people from different parts of the value chain, we can take care of their perspectives, and we can also obtain industry buy-in so that when the standard finally comes out, it's robust and practical and is useful for the end user. Now, how will the standard achieve its purpose? So in the next few slides, I'm going to look at definitions, classifications, disclosure requirements, and independent examination. And in the next few slides, you'll also see the icons. We've put color-coded icons on the top right-hand corner of the next slide so we can keep track of what we're talking about. So let's talk about definitions. It's not our intention to try and address the confusion in the marketplace by coming up with just a glossary, right? Because even if everyone agrees on the terminology, it's unlikely that everyone will start using the terms in a consistent way. It's a big world. So having said that, every standard needs a glossary. So we have kept ours pretty short. And this is the extent of the glossary that we have in our standard. So there are about 7 items. The one that I would like to highlight is the one in the middle, ESG-related feature. And this is a very important concept to us, and you see it in the paper and in today's presentation. Now, a feature can be objectives, it can be a constraint or policy, method, or some combination. The consultation sees investment products as having a bundle of features. And so if you have an ESG-related feature is a component or capability intentionally incorporated into the design of an investment product to provide a benefit for the investor that relies on ESG-related factors or addresses investors' ESG needs. And one product, an investment product, can have more than one ESG-related feature. Okay, now this term is going to come up again in the presentation. So, as we all know, it's probably very difficult to define complex product features through one-sentence glossary definitions. And that's why in the consultation paper, we spend a lot of time in fleshing out definitions and making them more robust. So for each ESG-related feature, you're going to see the name, its function, its benefits, how the features definition aligns with other organizations' definition, the alignment, notes and examples. And the consultation paper proposes 6 features, and they're listed here. So, and they are ESG integration, ESG related exclusions, best in class, ESG related thematic focus, impact objectives, and proxy voting engagement and stewardship. Now, some of you may be new to this terminology, or some of you may have come across this terminology maybe in the same way or in a slightly different, with slightly different meanings. And this is exactly why we've made the effort to give detailed explanations and refer to definitions of other organizations, so that people can get beyond these labels and understand the underlying substance. Now, what we are not trying to do is to reinvent the wheel. Our goal is to support terms that have a growing consensus. But for those terms that do not have have any consensus, we want to give clarity to those terms. Moving on to classification. There are many ways that investment products could be classified, and there's no right way, it just depends on what you're trying to do. So our intention is to classify ESG related features according to the needs they satisfy. So we're coming up with a list of ESG related needs. The consultation paper proposes 5 ESG related needs, and they're broadly as follows. Inclusion of comprehensive ESG risks and return considerations, alignment of personal beliefs and values. Some investors may want to make sure that their investments have few negative effects, i.e. doing no harm, or maybe doing some good. Some may want to capitalize on investment opportunities that relate to long-term trends. And lastly, some may want to be investing in products or solutions that bring a positive impact. Okay, we deliberately wrote these in a way that's accessible and meaningful to everyone, and we want to capture the spirit of what investors want beyond the traditional considerations of risks and return and time horizon. These needs are not mutually exclusive. As an investor, you can have none of them, you can have one or more of them, or you can have all of them. Okay, now it's important to note that, you know, it's difficult to capture all the needs. We want to capture as many, you know, as broad as possible, and this is also one of the things that that we have been consulting in the paper as well. Now, with needs and features established, we can map ESG related needs to ESG related features, and this table shows which feature an investor may want to consider if they have a particular set of ESG related needs. So, for example, if my need is the first need, i.e. I want to know that ESG factors that are material to the risk and return of my investments are explicitly considered, if that's my need, then I will know that the features that I should be looking for are A, ESG integration, and F, proxy voting, engagement, and stewardship. Okay. Now, of course, this is always the responsibility of the investor to conduct appropriate due diligence to make sure that a particular product meets their particular needs. But this standard can provide guidance for investors to find the most appropriate class of products that will suit their needs. And this matrix is actually in the consultation paper as well, and we're seeking feedback on whether people agree with what we suggested, as you know, and whether this is the right matrix, or whether there are other features, needs, relationship that we may have missed out or may be possible. Okay. Now, many, but not all, of the standards requirements relate to disclosures. And on this slide, we have laid out some design principles for those disclosure requirements. And it really boils down to this. If an asset manager claims that his product has an ESG related feature, then certain information needs to be disclosed. And today I want to highlight 3 principles: flexibility, content, and disclosure recommendations. Flexibility is the 3rd bullet point. What we want to say is we want to allow asset managers the flexibility to make the required disclosures by asking them open-ended questions like what, when, how, where. And the way we want to do this is so that even if we are looking at products from different markets, it will still be relevant. It will still be meaningful. The second principle I want to highlight is about content, and that's the 5th bullet point. We want the disclosure requirements to prioritize content over format, because that will reduce the asset manager's burden and allow for harmonization with other regulatory disclosures. And the other last point about design that I like to make is design disclosure recommendations, and that's the last bullet point. The standard will detail minimum disclosure requirements because that basically is the minimum disclosure required to make sure that the standard is met. But we will also be providing recommended disclosures that will allow asset managers to provide additional information, set a higher bar, but it's decision useful for the investor. Okay, now finally we come to independent examination. Now, disclosures are helpful in providing transparency and comparability, but there's always a risk of errors and omissions and misrepresentations. So our proposal is for an independent third-party examination of the investment products that claim compliance. And what it's designed to do is to provide a level of assurance to investors that what they see is what they're going to get. Now, independent examination is a very important part of any standard. If you don't have requirements that can be tested, then it's not really a standard. And this is also part of what we're seeking feedback on, whether the assurance should be based on the design of the product, i.e. its policies, procedures, and other constitutional documents, or the design and implementation, i.e. to the extent to which the product has been managed in accordance with policies and procedures. This is also a good place to talk about a few things that we haven't yet covered. The standard would apply only to those investment products offered by an asset manager that have one or more of the features defined in the standard as an ESG-related feature. And it's up to the asset managers to choose which products to which they apply the standard. Okay, but if a product has been chosen, then the entire standard will apply. Okay, so this is one key difference between this standard and GIPS, right? GIPS is applied at the entity level, whereas our ESG disclosure standard, as is proposed today, will be applied at the product level. Okay. Now, next I'd like to talk about users and benefits. There are a few key user groups. The ones that are listed here include investors, asset managers, and consultants and advisors. I've said it a few times, but we believe that this standard would be very beneficial for investors. It will allow investors to clearly identify and communicate their ESG-related needs and identify products that will meet their particular set of ESG-related needs. And it will allow investors to better compare and understand different products. For asset managers, this standard will also have certain benefits. It will allow them to communicate their ESG-related features of their products and allow them to market and explain the products across geographic borders. It will help create a level playing field and help asset managers respond to RFPs and due diligence questionnaires more efficiently. And for consultants and advisors, they will have a framework that allows them to discuss ESG-related needs and ESG-related features with clients and have greater confidence that their recommendations are aligned with what their client's trying to do. And indeed, I was talking to someone in Australia who's in the business of advising high net worth individuals and family offices. And he said this is exactly what he's looking for, because he's kind of struggling to have this conversation at the moment with his clients, even though it's something that he would really like to do. So how would this work? So this is a hypothetical table about different products and how they will show the different ESG related features. And imagine you are an investor trying to shop an ESG product, right? And you know what your ESG related needs are, you know what features you're looking for. And if you can be presented with a table like this, that shows you which product has which feature, then it's actually quite a bit of a breakthrough. So coming to the end of my presentation now, just a quick word on the timeline. The consultation paper was issued in August. The public comment period is going to finish on October 19th, which is next Monday. At the same time, we have been recruiting the next working groups to help us in the next stage. So we've been recruiting for volunteers on the ESG technical committee and the verification subcommittee. So once the comment period closes, we're going to analyze the comments and develop an exposure draft, which will come out hopefully in May 2021. When the exposure draft comes out, there will be a 60-day public comment period, after which we hope to have the final disclosure standards ready in November 2021. So if you're passionate about this, the way we are, we would love to hear your feedback on all our proposals. There are about 40 questions in the consultation paper. You do not have to answer all of them. If there are a few questions that you feel strongly about, please let us have your feedback. Okay, I'm afraid though, the recruitment for the volunteer committees has completed. So the applications for those committees ended in September. So I'm afraid we're looking for any more volunteers right now. But we are still looking for more. We would love to hear feedback on the consultation proposals. And that brings me to the end of my presentation. Happy to take any questions and would love to hear from you as to what you think about the standard. Thank you.
Thank you, Mary. I think there are a few questions in the chat box if you'd like to take them.
Let me see. Okay. So one question from Mohammed. With so many standards on ESG already in the market, how would another standard create space for itself and add value? That's the million-dollar question, Mohammed. Let me try and answer that. So what we have tried to, and I'll use this slide, the way we're trying to differentiate ourselves is to target a category that's actually not, it's not as crowded as, for example, the issuer disclosure space. So what we're trying to do is to, and our motivation is to help investors and asset managers to better communicate with each other to make sure that the frictional cost is lowered. Because it's a global standard, we can, will allow different products from different jurisdictions to be compared more easily. And because it's voluntary, we can actually raise the general level of standards across a number of different markets, particularly in markets that have no standards at all. So the EU is coming out with a lot of standards on around sustainability and ESG, but that is not shared in the rest of the world. So a lot of markets elsewhere are waiting and seeing, and they may not have the same, they may not see the same need. But by having a global voluntary standard, we can hopefully move the industry in the right direction. Okay. What, in your view, are key challenges that are likely to be encountered when adopting this standard? I think one of the key challenges will be to ensure that this standard will can work seamlessly with local regulations. So there will be markets that have more regulations. For example, in the EU, their regulations, their standards are already very high. So we want to make sure that our standard is also relevant in those markets. But as I said, regulators can put out standards, and they can compel people to make sure that the people that they regulate in their own market adopt those standards, right? But they have no jurisdiction outside that market, and so it makes it very difficult to compare across markets. But increasingly, capital is global, and by having our standard, it will help. It will motivate people to adopt the standard, because we can then again make better comparisons across the border. Okay, I have a question from Malik. Is there any analysis showing impact on earnings and family-owned governance structures due to new ESG standards? I think what you're getting at is whether companies that are managed in, that pay attention to ESG issues have a better performance. I hope that's what you mean. And indeed, there have been quite a bit of academic research that shows increasing body, a large body of evidence that shows that companies that are managed, that look after the ESG issues are going to outperform over time. One study I came across is a study done by Arabesque and the University of Oxford. They investigated over 200 academic studies and sources on sustainability. And what they found was that 80% of studies show solid ESG practices result in lower cost of capital, better operational performance, and better stock price performance. There's also another study done by the University of, I think, Hamburg, and they reviewed about 2,000 individual studies on the relationship between ESG and corporate finance performance. And basically, they found that about 90% of studies had a non-negative ESG and corporate finance performance relationship, and basically, and that positive ESG impact on performance appears stable over time. So there's a growing body of evidence. I encourage you to have a look at them, and if you're interested, I can send you the links to those reports that I looked at. But they're probably more newer ones that have come out as well in the past couple of years. Okay, question from Mohammed. Do we plan to introduce the concept of verification at some stage once standards achieve certain level of acceptance in the market? We want to introduce the concept of verification right away, so it's part of the standard. Again, this is to give credibility to the standard and make sure that investors who rely on claims that a product has complied with the standard is really, is really what they say it is. So to us, it's very important. But obviously, we're still open to whether the examination is on the design only or on the design and implementation. So that's something that we're going to decide later on. Another question from Mohammed. Are there any jurisdictions where ESG is well known? And in those markets, does the regulator encourage or require compliance with any ESG standard? I think the market that everyone's looking at is the EU. The EU is coming out with huge amounts of regulation. So they have a taxonomy that's being developed. They have a piece of legislation called non-financial information disclosure, NFRD, non-financial reporting standards. And this is a piece of legislation that will place obligations on issuers to disclose sustainability information. So that's called NFRD. And I mentioned the SFRD earlier. It's also a piece of EU legislation, but it's placed on, the onus of that is on asset managers. So asset managers have to disclose at the entity level, whether they're, how they've treated, how they have followed and pay attention to sustainability when they're making investment decisions, and at the product level, how that's how that's translated into the product level. And I think they're also talking about something called double materiality, i.e. how they're affecting, how they're making their decisions, and how those how they how they're carrying out that business. I'm not explaining that very well, but so in the EU they are very focused on ESG regulation and having a sustainable economy and making sure that investors are given as much information about the process and the products as possible. But if you look at the US, they are quite different. So the US doesn't seem to have the same zeal or enthusiasm for ESG at all. And a few months ago, the Department of Labor actually sent out a circular saying that, well, maybe for pension funds or pension advisors, you may not want to, we may not want you to be showing your clients ESG products. So this is it's a very different attitude. So it seems there is quite a bit of divergence between different parts of the world as to how they're approaching the issue of ESG. But what we are seeing in general is that we are seeing quite a bit of push from regulators in issuer disclosures and in investment governance. By investment governance, what I mean is the whole concept of stewardship, right? So what we've seen is that a lot of markets have issued what we call stewardship codes, which encourage or request asset managers to be more responsible stewards of capital. And by that, they mean that investors should be talking to their companies more often, engaging with their investee companies, motivating them to do better, especially on the ESG front, and also to do more voting and explain their voting decisions to their end clients. So yes, so we're seeing a lot of push from the regulators on both issuer disclosures and on the investment governance. The other area that we're seeing is on labeling, and that's quite, again, that's a bit of an EU feature. So what they're saying is, well, maybe for retail products we can put a label on it so that people can know whether it's ESG or green or what. It is not something that we are focused on. If you look at our standard, and if you're thinking about, say, buying a bar of chocolate, right? The label will be, whether the chocolate is organic and what sorts of standards you have to meet before you can put the label on that says organic. So we are not into that area at all. What we are trying to do is provide standards for the ingredients list. So when do you have to disclose your ingredients? Is it 1% or 0.1%? So So our standard is different in that way. Okay.
We have one more question from Farhan.
Hello, Farhan. Let me read your question. Will CFA Institute be publishing special guidelines for regulators to ensure that ESG disclosures are of high quality and useful to investors and asset managers? So these ESG disclosures that you are talking about are ESG disclosures from issuers, correct? So yes, we have been advocating for high quality disclosures, and I absolutely agree they should be decision useful. Last year we published a report that looked at issuer disclosure regimes in 7 APAC markets, and they're very different. Some are voluntary, some are mandatory, some are comply and explain. But when you, unfortunately, when you ask a company to do something as a regulator, the company treats it as a compliance exercise. And therefore they will do it, but the quality is not always there. You know, they will do the minimum level of disclosure to make sure that they can get away with it. So there's a bit of a gap still. I think again, it depends on the market. There's quite a bit of work to be done to make sure that issuers really see the benefits of these disclosures. A lot of issuers don't, and they treat it as a compliance exercise. When they do, and so I think the industry also has a you know, should also look at should also try and articulate the value proposition better and motivate companies to do better disclosures. And I think what's in it for the companies is that if they are trying to diversify their shareholder base, they're trying to diversify their capital base by speaking the sustainability language better, they can attract more, you know, a wider set of shareholders. And I think you know, the ability for us to tell that story, to convince companies that there is something in it for them other than, you know, a compliance exercise is very important, and it will help drive standards up. I think at the moment, yeah, I think in each market there will be companies who are way ahead and have demonstrated, you know, that they understand what this is about and will want to do well in this area. But there's a long tail, and I think we're trying very hard to move progress for that tail. Okay, I think we have time for one last question. Can you share if any ESG standard is prevalent in use in practice in our neighboring and similar markets like India, Bangladesh, and Sri Lanka? As far as I know, no. But again, I think ESG standard is a very loose term. If we're looking at ESG corporate, you know, issuer disclosures, India does have some requirements. I'm not familiar with Bangladesh or Sri Lanka or Pakistan. And as I said, this is you know, this is something that is still being developed. But one market that's maybe further away from Pakistan, but it's also an emerging market in Asia that's actually done really, really well in terms of issuer disclosures is Thailand. So we were looking at a global ranking of you know, issuer disclosures, issuer ESG disclosures. And of the top 10, there was only one stock exchange that came from Asia Pacific, and that was Thailand. So Thai companies have actually done really well in terms of providing timely disclosures, providing you know, key metrics that investors want to see. And that's because the Thai Stock Exchange apparently has done a lot of work in motivating and educating companies to understand the value of these disclosures and to provide them with the skills necessary to report those, to make those reports. So yeah, so I think Thailand is a very interesting case study. Okay, with that, Sarah, I'll hand over to you. Thank you.
Well, thank you so much, Mary, for this highly insightful session. I would just like to mention, as Shaib initially mentioned, that about ARX, we are doing an awareness session on ARX on the 29th of October, and we'll just post the link on this chat for you. Also, sharing the feedback form with you. Please do let us have your feedback on the session. You can scan this, or alternatively, we'll just post the link in the chat box for you to give us the feedback. And thank you so much, everyone, for for attending the session. Thank you, Mary, so much for being here, and we hope to see more of you with us. And thank you, Shaib, and thank you, everyone else.
Thank you. Have a good day.
Bye.
Bye-bye.
Bye.